Welcome to Celebrity Investing, your go-to source for insights, tips, and updates on navigating the exciting landscape of personal and global finance. Please like, share, and subscribe for more exclusive content. This is part 1 of how Basel Accords shaped the global financial system. Understanding the Basel Accords, Basel I, II, and III explained. The Basel Accords set global standards for managing risks in the banking industry. These agreements were created to ensure financial stability and keep banks accountable. Basel I focused on credit risk. Basel II introduced operational and market risk, and Basel III strengthened banks' ability to endure economic disruptions. Together, they shape the way banks operate and protect the global economy from financial crises. Overview of the Basel Accords. The Basel Accords are a cornerstone of global banking regulation. They guide how banks manage risks and safeguard financial stability worldwide. Developed through international cooperation, these agreements aim to prevent banking crises by setting standards for capital requirements, risk management, and transparency. Over the years, the Accords have evolved to address emerging challenges and ensure banks remain resilient in times of economic uncertainty. Purpose and importance. Why were the Basel Accords created in the first place? Banks are central to the global economy, holding the savings of individuals and funding businesses. However, when banks fail, the consequences ripple far beyond the financial sector, impacting jobs, investments, and livelihoods. The Basel Accords were introduced to minimize these risks and build trust in the banking system. The primary goal of the Accords is stability. By requiring banks to hold sufficient capital reserves, they ensure that financial institutions can absorb losses during tough times. This reduces the likelihood of bank defaults, protecting depositors and preventing economic contagion. Think of it like a safety net for the banking world. It might not stop every fall, but it drastically reduces the damage. Another critical aspect is uniformity. The Accords set standards that banks across the globe must follow, creating consistency in how financial risks are managed. This international approach is vital in today's interconnected world. Without it, disparities in regulations could lead to imbalances, with risks piling up in less regulated regions. The Basel Accords act as a referee in the global financial arena. Key institutions. At the heart of the Basel Accords is the Basel Committee on Banking Supervision, BCBS, a group of banking regulators from key economies. Established in 1974 by the central bank governors of the G10 countries, the BCBS operates under the Bank for International Settlements, BIS. Its mission is straightforward: create a safer banking environment by setting global standards and providing a platform for international cooperation. While the BCBS does not enforce these rules, it has no legal authority, it shapes the framework that countries can adopt into their own regulations. Most major financial hubs, from the European Union to the United States, align their banking laws with Basel standards. Other key players include national regulators and central banks. They are responsible for implementing Basel guidelines and monitoring compliance within their jurisdictions. These institutions tailor the standards to local conditions while maintaining the spirit of the Accords. For example, the Federal Reserve in the US and the European Central Bank in the EU oversee how the Basel rules are applied in their respective regions. In short, the BCBS sets the playbook, but national regulators are the ones making sure the game is played fairly. This blend of global and local oversight is what makes the Basel Accords both robust and adaptable. Basel I, the foundation. Basel I, introduced in 1988 by the Basel Committee on Banking Supervision, BCBS, was the first global framework for regulating banks. Its primary goal was to ensure that banks held enough capital to absorb potential losses, reducing the risk of failure. By establishing clear rules, Basel I sought to protect the financial system and restore public confidence in banking. Though simple in design, it laid the groundwork for future regulations. Capital adequacy requirements. At the heart of Basel I was the concept of capital adequacy. This required banks to maintain a minimum amount of capital relative to their risk-weighted assets. Essentially, banks needed to keep a financial safety cushion to cover potential losses without jeopardizing depositors' money. The BCBS set the minimum capital to risk-weighted assets ratio, CRAR, at 8%, meaning banks had to hold at least $8 in capital for every $100 of risk-weighted assets. The capital itself was divided into two tiers. Tier 1 capital. This included core elements like common stock and disclosed reserves, which are the most reliable buffers against losses. Tier 2 capital. This consisted of supplementary items like subordinated debt and undisclosed reserves, which were less stable but still counted toward the capital base. By enforcing these standards, Basel I created a universal baseline. It encouraged banks to operate more prudently, ensuring they had the financial strength to withstand uncertainty. Risk weighting of assets. Basel I introduced a risk weighting system to categorize a bank's assets based on their credit risk. The idea was simple. Riskier assets required more capital, while safer ones required less. This system created a tiered structure for evaluating the risk of loans, investments, and other holdings on a bank's balance sheet. Assets were assigned risk weights, ranging from 0% to 100%, depending on the perceived likelihood that borrowers would default. For example, 0% risk weight, cash and government bonds from stable countries, considered virtually risk-free. 20% risk weight, claims on banks in strong economies. 50% risk weight, residential mortgages acknowledging moderate risk. 100% risk weight, corporate loans or investments in riskier regions. This framework incentivized banks to balance their portfolios carefully. By holding lower risk assets, they could reduce the amount of capital needed. On the flip side, investing in higher risk assets required banks to set aside more capital, discouraging reckless behavior. Impact on banking sector. The adoption of Basel I had a noticeable impact on how banks operated and managed risks. For one, it standardized capital guidelines globally. This helped level the playing field, ensuring consistent rules across international borders. Banks, regardless of location, now had a clearer understanding of what was expected of them. Some of the immediate effects included improved stability. Banks were better equipped to handle losses, reducing the chance of costly failures. Shift in lending practices. Institutions became more cautious in their lending, prioritizing safer loans to lower their risk exposure. Increased competition. Smaller banks and less regulated financial institutions sometimes found it harder to compete, as meeting capital requirements could strain their resources. Enhanced public trust. Knowing banks were required to hold reserves reassured customers and investors alike. However, Basel I was not without its limitations. It oversimplified risk categories and didn't account for some of the more sophisticated financial activities that banks engaged in. These shortcomings would later be addressed in Basel II, but Basel I's legacy as a vital stepping stone can't be understated. It set the stage for a new era of responsible banking. Basel II, enhancements and challenges. Basel II represented a significant step forward in global banking regulation. Introduced in 2004, it built on Basel I's by creating a more comprehensive framework for addressing risks banks faced. Its goal was to make banks more resilient, improve risk management, and enhance transparency for stakeholders. However, with these advancements came challenges that highlighted the complexity of regulating a global financial system. 3 pillars of regulation. Basel II introduced its approach through 3 pillars, each serving a unique role in the regulatory framework. Together, these pillars sought to reinforce banking stability while promoting accountability and market confidence. Stay tuned and continue to watch our videos to gain valuable insights into the world of finance. Subscribe, like and share to continue your journey to financial success.